Gold prices climbed to 1,630 level earlier today, rebounding from two-year lows level as the greenback takes a breather near its highs. Nonetheless, the substandard performance of gold extends as central banks across the globe act forcefully by aggressively hiking rates in an attempt to curb inflationary pressures and thus dampen the precious metals shine. Not only that, but also the OECD's downward revision for global economic growth for 2023 intensified but also validated the widespread fears of economic slowdowns worldwide. In this report, we aim to shed light on the catalysts driving the precious metals price, assess its future outlook, and conclude with a technical analysis. The greenback continues to reign supreme in the FX market, and gold on the other side of the spectrum experiences wave after wave of outflows due to their negative correlation. Dollar strength has been maintained after Fed's interest rate decision, which is widely anticipated, raised the Fed funds rate by another 75 basis points, marking its third consecutive jumbo rate hike. In its accompanying statement, the central bank explicitly expressed its unified commitment at bringing down inflation towards the 2% target level, and in the revised dot plot graph, the committee's plans shifted towards raising interest rate higher and for a prolonged period, with a possible ceiling of 5% being hit in 2023 as the threat of inflationary pressures becoming deeply entrenched in the economy rose substantially. Fed Chairman Powell's speech following the decision carried a hawkish tone and warned of pain ahead for the economy as the central bank attempts to cool demand. Particularly striking was the Fed Chair Powell's inability to assess the probability of the US economy falling into recession, given the radical pace of interest rate raising concerns across the markets. The concerns were evidently reflected across the bond markets, where the US 10-year yield was on the rise, highlighting market worries, and the 2-year yield soared the new highs, indicating the market anticipates the recession to hit the US sooner rather than later. Since higher interest rates raise the opportunity cost of holding non-yield bullion, as well as the attractiveness that high bond yields bear, the shine of the yellow metal dampens, falling out of favor of investors' portfolios. During this week, a series of FOMC members are scheduled to deliver speeches, and the market anticipate further incoming pain for the shiny metal should their aggressive stance be maintained. Yesterday, Cleveland Fed President Mester did just that, when she stated that the US Central Bank needs to keep policy restrictive for some time. And if there is an error to be made, better that the Fed do much than to do too little. Reiterating the committee's anonymous narrative, a similar message was delivered by Chicago Fed President Evans in favor for raising interest rates further, stating that my viewpoint is roughly in line with the median assessment, giving, or at least maintaining for the time being, credibility in the central bank's actions. To conclude, we note the scheduled speeches by St. Louis Fed President Bullard, Fed Governor Baumann, Atlanta Fed President Bostic, and Richmond Fed President Barkin, all taking place tomorrow, Wednesday, the 27th of September. Thank you for watching.